property investment landscape continues to evolve, with investors increasingly weighing the merits of housing multiple occupation against traditional single-let properties. As we progress through 2025, understanding the financial dynamics, the regulatory requirements and the operational complexities of each strategy has become crucial for making informed investment decisions. Understanding the investment models. HMO properties involve renting individual rooms to multiple tenants who share common areas like kitchens and bathrooms. These properties typically house 3 or more unrelated tenants and generate income from multiple rental streams within a single property. Single-let properties follow the traditional model of renting an entire property to one tenant or one family unit, providing a single monthly rental income with generally lower management requirements. Financial returns, the numbers game. The rental yield comparison between HMOs and single-lets reveals compelling differences. HMO properties consistently demonstrate higher gross rental yields. However, these higher gross yields come with significantly increased operational costs. HMO properties face elevated expenses for utilities, maintenance, insurance, and in licensing fees. Capital appreciation patterns also differ between the strategies. Single-let properties in desirable residential areas often experience stronger long-term capital growth, particularly in family-focused areas. HMO properties may see more modest capital appreciation, but compensate through superior rental income generation. The licensing requirements and the regulatory landscape. The regulatory framework for HMOs has become increasingly stringent, creating substantial compliance obligations for investors. Mandatory HMO licensing applies to properties housing 5 or more tenants, forming 2 or more households, with many local authorities extending licenses and requirements to smaller HMOs. Licensing applications typically cost between £500 to £1,500 and require comprehensive property inspections, fire safety compliance and ongoing management standards. Properties must meet minimum specific room requirements too. Kitchen and bathroom ratio must also align with the occupancy levels, often requiring costly retrofitting. Single-let properties operate under simpler regulatory frameworks, primarily governed by standard landlord to tenant legislation and basic safety requirements like gas safety certificates and electrical inspections. The administrative burden remains significantly lower with fewer ongoing compliance obligations. Managing the complexity and operational demands. HMO management presents multifaceted challenges that extend far beyond traditional property management. Tenant turnover rates typically run higher than single lets, creating constant marketing viewing and vetting responsibilities. Managing multiple tenant relationships within shared spaces requires diplomatic skills and swift conflict resolution. Maintenance schedules intensify with HMO properties because the common areas, for instance, require frequent cleaning and upkeep while coordinating repairs around multiple tenant schedules. This also adds some logistical complexity. Utility management becomes particularly challenging with disputes over usage and responsibility in the commonplace. Single-let properties offer streamlined management with single-point tenant communication and more predictable maintenance cycles. Property inspections occur less frequently and tenant-related issues typically involve fewer parties and complications. The market positioning and tenant demographics. HMO properties serve distinct market segments, primarily young professionals, students and individuals seeking affordable housing in expensive urban areas. This demographic often provides steady demand but may prioritise flexibility over longer-term tenancy commitments. Location selection becomes critical for HMO success, with properties near universities, transport links and employment centres commanding premium rents. Urban areas with housing shortages and high property prices create ideal conditions for HMO investments. Single-let properties attract families and established professionals seeking privacy and stability. These tenants often sign longer leases and maintain properties to higher standards, though they may demand more significant property features and conditions. Financial planning considerations. Initial investment requirements differ substantially between strategies. HMO conversions often demand significant upfront capital for compliance moderations and furniture and licensing and the processes. Cash flow patterns also vary considerably. HMOs provide multiple income streams that can partially offset individual tenant losses, but void periods may affect multiple rooms simultaneously. Single lets offer predictable monthly income but create total income loss during vacancy periods. Insurance costs reflect the risk of profiles of each strategy too. Looking at the risk assessment and also the mitigation. HMO investments carry elevated risks across multiple dimensions. Regulatory changes can significantly impact profitability, with licensing fees increasing or additional compliance requirements. The complexity of managing multiple tenants creates greater potential for dispute, greater potential property damage, and also legal complications. Market saturation presents an emerging risk in some areas where HMO supply has expanded rapidly. Local authority policies increasingly restrict HMO development through Article 4 directions. Single-let properties face different risk profiles, primarily centred on tenant quality and market conditions. Consider your options. For investors seeking maximum rental yield and willing to embrace active management, HMO properties offer compelling returns in the right locations. Success requires thorough local market research, adequate capital reserves for compliance and maintenance, and either personal management capabilities or access to experienced HMO management services. Conservative investors or those prioritising passive income should consider single-let properties, particularly in areas with strong rental demand and capital growth potential. The lower management burden and simplified compliance requirements suit investors with limited time or property management experience. Portfolio diversification strategies might incorporate both approaches, using single lets for stable base income while selectively adding HMO properties in high demand areas for yield enhancement. The regulatory environment will likely continue to evolve, with increased scrutiny on HMO standards and potential additional licensing requirements. Investors should factor ongoing compliance costs and regulatory changes into long-term financial projections. The choice between HMO and single-let investments ultimately depends on individual investor profiles, the risk tolerance, and your management capacity. While HMOs offer superior rental yields, they demand significantly higher operational involvement and regulatory compliance. Single lets provide simplicity and stability, but with more modest returns. Success in either strategy requires thorough market analysis. It requires adequate financial resources and realistic assessment of personal management capabilities. As the property investment landscape continues evolving, investors who align with their strategies, with their resources and objectives will achieve the most sustainable long-term returns.